Yeah. So welcome to day 3 handwritten notes marathon. Coming to today's agenda. Today I'm covering 4 topics. Chapter 8 dividends, weightage 5 marks. Chapter 9 accounts of company. So the weightage is 5 to 11 marks. Generally one question comes from accounts of companies, but if you see last 3 to 4 attempts, either 2 questions are coming from accounts of companies or one descriptive question plus 3 MCQs. So that's why the weightage would be 5 to 11. Chapter 10 audit and auditors, weightage 5 marks. And last one, General Clauses Act, the weightage is 14 marks. So total 29 to 35 marks comes from these 4 topics, and these 4 topics you can see the handwritten notes. Forgot to tell you, day 1 handwritten notes PDF, day 2 handwritten notes PDF, and day 3, that means the copy which you can see on the screen. So these 3 PDF copies were already uploaded on the drive. So the video description, in the video description you can find the link. Just click on the link, you will find 3 PDF copies, you can download them. And all the corrections also, I did it. So that is a rectified copy only, 99% error free document. You can read it once, you can use it once. And before I start, one more time, let me tell you the disclaimer. See, this is not a substitute to the classroom discussion. This is only a solution, or this is a, if you are facing a problem of revising hundreds of the pages just 10 days or 2 weeks before examination, if you are having the problem, so this marathon, this handwritten notes marathon is a solution to that problem. Clear? So just participate, listen carefully, so get maximum advantage. Okay, chalo, let's begin the marathon. Let's continue with chapter 8, declaration and payment of dividends. In dividends, we are having only 5 sections, 123 to 127. First one, 123. In 123, we will cover sources for declaration of dividend, transfer to reserves, declaration of dividends in case of no profits or inadequacy of profits. Next one, depositing dividend amount, payment of dividend amount, and companies that are prohibited from declaration and payment of dividends. Let's see one by one. First one, sources. For the financial year 25-26, say for example, for the financial year 25-26, if you are declaring dividends, then 25-26 current financial year profits after providing for depreciation, or profits of previous financial years. So accumulated profits, accumulated reserves after providing for depreciation, and combination of current financial year profits and previous financial year profits. Last one, provision by the government, that is any money provided by central government or state government under the guarantee. So these monies can be utilized for declaration and payment of the dividend. Very important point, you have to remember this word depreciation. In examination, they may ask you a problem, they may give you profits without depreciation, before deducting depreciation, and they will give you depreciation separately. Now it's our duty to deduct depreciation from the profits. Clear? Next one, note point. Previous year company incurred losses, current year company got profit. Now can I declare entire profit as dividends? No. First, set off carry forward previous year losses and depreciation before declaring current year's dividend. And in this process, any unrealized gains, notional gains, and revaluation of assets, revaluation reserves, fair value changes should not be considered. Fair value changes, you all know in branch accounts, when you combine the figures of foreign branch with Indian head office and Indian branches, so all the current assets and current liabilities are valued at closing prices, right? Closing rates. So there, any exchange differences, all those exchange differences are just notional gains or notional losses. They will not be considered while calculating, profits. Getting the point? So notional gains shall not be considered. Revaluation reserves shall not be considered. Fair value changes shall not be considered. Next one, capital profits are not distributable profits. So dividends cannot be declared out of capital profits. Next one, Companies Act 2013 gave freedom to the companies in transferring profits to the reserves. Companies may transfer any portion of profits to the reserves. It is completely at the discretionary powers of directors. So directors will decide how much to transfer to reserves, how much to be considered for declaration and payment of dividends? It's up to the directors. Next one, in case of inadequate profits, dividends can be declared out of accumulated profits from the previous years. For that, we need to follow rule 3 of companies declaration and payment of dividend rules 2014. So coming to the conditions, here you can see the first condition is about rate of dividend, maximum rate of dividend. So beyond this you cannot declare. What is the first one? Dividend rate cannot exceed average of last 3 years. Sir, suppose last 3 years company didn't declare any dividend, sir, then condition number 1 is not applicable to you. Condition 1 is applicable only when company had declared dividend in the last 3 financial years. Suppose last 3 financial years, the rate of dividends, let's see, year 1, year 2, year 3, last 3 years, 10%, 12%, 14%. So average of these 3 is 12%. Next, total amount drawn must not exceed 10% of paid up share capital and free reserves. Suppose paid up share capital of the company is 100 crores, free reserves some 30 crores. Now this is condition number 1. As per condition number 2, 10% of paid up share capital plus free reserves. So that means 10% of 130 crores is equal to 13 crores. Next, condition 3. Let's say condition 3. Amount must first offset current year losses. Suppose current year loss equal to some 3 crores. So first you decided to withdraw 13, right? 13 minus 3 CR, so 10 CR. Next one, reserves after withdrawal should not fall below 15% of the paid up share capital. So condition number 4, my paid up share capital is 100 crores into 15%. That means 15 crores. So post withdrawal, free reserves balance should not fall below 15. That means even if I withdraw 15 crores, the balance will be 15. Even if I withdraw 15 crores, the balance will be 15. But if you see, 10 crores is less than 15 crores. So I can withdraw 10 CR and I can pay dividends. You can also calculate like this. For example, condition number 1. As per condition number 1, what is the rate of dividend I can declare? 12%. What is condition number 2? 1/10 of the paid up share capital plus free reserves. So that means 13 crores. Directly I'll jump to condition number 4. What is condition number 4? Post withdrawal, the balance in free reserves shall not fall below 15% of the paid up share capital. Right now, my free reserves is 30 crores, correct? Minus 15% of paid up share capital. 15% of paid up share capital, that means 15% of 100 crores. So 30 minus 15, so which will be 15 crores. So out of 13 or 15, whichever is lower means, of course, I need to withdraw only 13 crores. I can withdraw only 13 crores. I can withdraw 13 crores. From this 13 crores, now I will apply condition number 3. What is condition number 3? First, offset current year losses. Current year loss, as I told you, 3 crores, right? So 13 minus 3 crores. So I can utilize 10 crores only. Anyway, you can do 10 CR, 10 CR. Okay, sir. So 10 CR. Whereas rate is telling 12%. As per rate, 100 crores into 12% means 12 crores I can declare. But source permits me 10 crores only. So 12 crores is also not possible. Maximum current year I can declare 10% dividends. Getting my point? Rate is telling you can go up to 12%. But source is permitting me 10 CR only. Again, out of these two, whichever is lower means 10 CR only I can withdraw. 10 CR only I can declare and pay as a dividends. Getting it? So that's all about these 4 conditions. Next one, dividend must be deposited in a separate account with a scheduled bank within 5 days from declaration. So generally, you all know dividend includes interim dividend. Dividend include interim dividend. So that means we are having 2 types of dividends. One is final dividend and second one is interim dividend. What is the difference between final dividend and interim dividend? You know, final dividend is a dividend declared at AGM. Interim dividend is declared at board meetings. Okay, now final dividend is proposed by board of directors, declared by members. Whereas interim dividend proposed by board of directors, declared by board of directors only. Okay, now so this is the difference between final dividend and interim dividend. Now coming to this point, from the date of declaration onwards, within 5 days, transfer dividend amount to separate bank account. Next one, payment should be done to the only registered shareholders or to the order of the registered shareholder. It must be paid in cash only. That means kind was prohibited. Dividends, payment of dividends in kind is prohibited. Dividends must always be paid in cash only. That too not in physical cash but through banking channel. That means checks, dividend warrants, electronic modes. And dividends must be paid within 30 days of declaration. Another confusing point, observe carefully, day 0, it is nothing but declaration of dividend. Declaration. From here onwards, by day 5, transfer dividend amount to separate bank account. Separate bank account. SB account means separate bank account. And by day 30, payment should be done. Payment to registered shareholders or to the order of the registered shareholders. Getting my point? So this is 5 days. And here you will see 25 days. Total 5 plus 25, total we will have 30 days duration. It's not 5 plus 30. It's 30 including 5. Next one. Two companies are prohibited from declaration and payment of dividends. Which two companies? One is section 74 non-compliance companies. That means company which has committed default in repayment of deposits, payment of interest on deposits. Then that company is prohibited from declaration and payment of dividends. And section 8 companies, they are not doing business activities, they are doing charitable activities. Then how can they declare dividends? It's not a profit, it's a excess of income over expenditure which shall be utilized only for the purpose of carrying company activities, company objects, that's it. So these two companies are prohibited from declaration and payment of dividends. Next, section 124, unpaid dividend account. Unpaid dividend account. First one, if any dividend is unpaid or unclaimed within 30 days of declaration, the company must transfer unpaid dividend amount to unpaid dividend account within 7 days after 30 days. So simply from day 30 onwards, you will have 7 days. That means day 37. You will have 7 days to transfer all unclaimed and unpaid dividends to a separate bank account, that is unpaid dividend account. And once you transfer that amount to unpaid dividend account, within 90 days, prepare a statement which should consist of name of the member, address of the member, and amounts of unpaid dividends. So it must contain 3 particulars, names, address, amount of unpaid dividends, and it must be published on company website as well as government approved website. And this entire process should be completed within 90 days. Listen carefully. The statement should contain 3 particulars: names, address, unpaid dividend amounts. If company fails to transfer unpaid dividend to unpaid dividend account, separate bank account, then interest at the rate of 12% per annum will be added, and it will be used in repaying those amounts to the members in proportionate to their unpaid amounts. So proportionate settlement. Any interest company is adding because of delay in transferring to unpaid dividend account, that interest in proportion to unclaimed or unpaid dividends will be paid to the members itself. Will be paid to the members. Next one, claiming unpaid dividends. Claimants, that means the persons who didn't claim dividend may apply to the company for payment of amount to transfer to unpaid dividend account. And any unpaid dividend remaining unclaimed for 7 years will be transferred to IEPF along with interest, and a statement will be sent to IEPF authority. So 7 years. What is the time period to keep it in unpaid dividend account? 7 years. Once 7 years is over, then transfer all those amounts to IEPF, Investor Education and Protection Fund. Shares for which dividend has not been paid or claimed for 7 consecutive years will be transferred to IEPF unless any dividend is paid or claimed in that period. For example, year 1 dividend unclaimed, year 2 dividend unclaimed, year 3 dividend unclaimed, year 4 dividend unclaimed, year 5 dividend claimed. Now year 6 dividend unclaimed. Here is it year 6 or year 1, sir? It is not year 6, it is year 1. Any year if he claims dividend, the next year if he is not claiming the dividend, that year will be considered as year 1 only. 7 consecutive years. Any break means after break, the first year will be year 1 only. Getting the point? And only dividends which remains unclaimed for 7 financial years shall be transferred to IEPF account. The owner of the transferred shares can apply to IEPF can reclaim them by following the prescribed procedure and submitting the required documents. So very simple. So once dividend is transferred to unpaid dividend account, then it will be there in that account for 7 years. During this tenure, member can file an application with company and member can claim dividends. Suppose 7 years completed, sir, from unpaid dividend account, amounts, shares transferred to IEPF account, sir. Now here member has to file an application with IEPF, submit requisite documents, then IEPF will return that money, IEPF will return the shares to that applicant. Failure to comply with these provisions, company 1 lakh plus 500 per day, maximum 10 lakhs. Officer in default 25,000 plus 100 per day, up to 2 lakhs rupees. This is the punishment for non-compliance. So here you can see flow of unpaid dividends. Declared dividend within 30 days not paid, unclaimed. Within next 7 days transfer to unpaid dividend account. And after transfer is done, then within 90 days publish a statement. Statement should consider 3 particulars. Again I am telling you because in one MCQ I have seen it. Statement contain only 2 particulars. Valida, invalida, invalid. 3 particulars to be there. Name, address and unpaid dividend amounts. After 7 years transfer to IEPF. Any interest accumulated, that also you transfer it. So that's all about section 124. Next is section 125, Investor Education and Protection Fund. So if you see, the first one is amounts credited to IEPF. Grants by central government, donations from government or institutions, unpaid dividends. Next one, amount from general revenue account, amount from IEPF under Old Companies Act, income from investments, amount from disgorgement or disposal of securities under section 38, unclaimed application money, unclaimed mature deposits, unclaimed mature debentures, interest on the above amounts. If you see this unclaimed for a tenure of 7 years. For 7 years, if the amount remain unclaimed, then only these amounts shall be transferred. Even for redemption of preference shares also, 7 years condition is applicable. 7 years is applicable to security application money unclaimed, deposits matured unclaimed, debentures matured unclaimed, interest on the above amounts, as well as redemption amount of preference shares. Unclaimed for 7 years, then amount shall be transferred to IEPF. Next one, sale proceeds of fractional shares. In case of bonus issue or rights issue, any fraction part was allotted, any fractional part was there, a fractional token was there. So IEPF can sell that fractions and the amount shall be credited to IEPF account. Any other prescribed amounts. And the fund is utilized only for the following purposes. Refund of monies. If any applicant come forward and files an application, amount will be refunded to that applicant. Promotion of investor education and protection, distribution of discharged amounts to the eligible claimants, reimbursement of legal expenses for class action suits and other incidental purposes as per the rules. So these are the utilization of the fund. Next one, refund of amount. A person can claim a refund from the fund for amounts transferred under section 125 subsection 2 of Companies Act 2013 even after expiry of 7 years. Not only dividend amounts but also shares can be reclaimed. Okay, next one, any claimant can apply to IEPF authority for payment of unclaimed amounts as per the rules. Next, coming to constitution. So committee, you can see the board, IEPF authority board. IEPF authority administers the fund including maintenance of accounts and records. The ex officio chairperson is the secretary MCA. Secretary MCA is the ex officio chairperson of IEPF authority. Simply, the chairperson of IEPF authority is none other than Secretary MCA. The authority also includes not exceeding 7 members and a CEO. So simply chairperson, 7 other members plus a CEO. Max to max 9. Next one, central government may provide necessary offices, staff and resources to the authority for administering the fund. So resources for administering the fund. Next one, authority in consultation with C&AG is responsible for maintaining accounts, records of the fund, and that C&AG will conduct the audit and will give audit report. Finally, annual report including audit report shall be placed in front of members of parliament. So authority can spend the fund only for the specified purposes, only for these 5 purposes authority can use the fund. Fund accounts will be audited by C&AG at specified intervals, monthly or quarterly or half yearly. And the audit report will be forwarded to the central government. The authority prepares an annual report detailing its activities for the financial year and submits it to central government, which lays it before members of parliament. So that is all about section 125. In the section 125, just remember the authority constitution, chairperson, next one CEO, and other members not exceeding 7. And who do audit of IEPF records? C and AG. Credits and utilization of the fund also, just give one time reading, that's it. Next one, section 126. Rights of the dividends, right shares and bonus shares to be held in abeyance, that means hold pending registration of transfer of shares. Under section 56, if you remember, under section 56, there is a transfer of shares between transferor and transferee. Imagine these shares are partly paid up. Application is executed by transferor alone. Now it is the duty of company to give a notice to transferee. If there is no objection from transferee, then only company will register the transfer and company will issue share certificate in the name of transferee, correct? Suppose the process is going on, meanwhile company declared dividends. Now to whom we should pay dividends, sir? Transferor already company received documents for registration of transfer. But transferee is not a registered shareholder. Transferor is the registered shareholder. Transfer registration is pending. Meanwhile, company declared dividends. Now, to whom we should pay dividends? So, since registered shareholder, transferor, but he already transferred the shares, then transferee, he is not a registered shareholder, then to whom we should pay benefits? So, lawmaker is telling, don't pay benefits to anyone, just keep them hold, transfer them to unpaid dividend account. Once you receive any instruction from the transferor, sir, please make payment to transferee. If that instruction was in writing, then make payment to transferee. Until then, keep them hold. That's it. Also, right shares, bonus shares will be kept in abeyance. Once registration is done, then benefits will be given to the registered shareholder, nothing but transferee. Next one. So simply key point, no benefit to unregistered transferee until transfer is registered, or else the authorization should be in writing, or else authorized in writing. Next, section 127. Punishment for failure to distribute dividends within 30 days. As you all know, date of declaration of dividend considered as day 0. Amount shall be transferred to separate bank account by day 5, and it shall be paid to the shareholders, that means registered shareholders, by day 30. If not paid by day 30, then what would be the consequences? That is section 127. Chalo, let's see. A company must pay or post the dividend warrant within 30 days from the date of declaration. Posting the warrant within 30 days discharges company from punishment, even if shareholder does not receive it within 30 days. Your duty is to pay the dividends. You are paying the dividends, by issuing a checks. However, registered shareholder received the check after 30 days. It's not a company's problem. The offense occurs if the company fails to post the dividend warrants within 30 days. What happens if company posts dividend warrants after 30 days? That is the section 127 punishment. So director's punishment is imprisonment up to 2 years, fine 1,000 for every day during such default continues. Coming to the company should add interest at the rate of 18% per annum. So company punishment is pay dividend, add interest at the rate of 18%. Directors in default, for them, the punishment is imprisonment up to 2 years and fine 1,000 per day during such default continues. And there will be no punishment in the following cases. Failure is due to any law. Failure is due to operation of law. Failure is due to directions from the shareholder that cannot be complied with and same communicated to the shareholder. We had many practical questions where shareholder will give directions to the company. Company found difficulty in complying with the directions, but company forgot to communicate that to the shareholder. Getting the point? Suppose, company is posting dividend warrants. One particular member told, sir, don't post any dividend warrants, directly credit to my account, bank account. So directly do NEFT or RTGS. Company tried of doing RTGS NEFT, but since name mismatch, some other details mismatch, the payment was not completed. Now it is the duty of company to communicate the same with the registered shareholder. If company fails to communicate with registered shareholder, then punishment is applicable. Here two conditions are there. See, first, unable to comply with the directions of the shareholder, and the same shall be communicated to the shareholder. Same should be communicated to the shareholder. Then only punishment not applicable. Next one, dispute, ownership dispute. Next one, adjustment of the dividends against lawful dues. Suppose shareholder is holding shares with calls in arrears, or shareholder is having some lawful dues to the company. Now adjustment against dues or any other reasons not due to company's default. Suppose lockdown, during lockdown, even if company posts warrants, so postal department will not work to dispatch and to submit all these dividend warrants to the eligible registered shareholders. So if it is not due to company's default, then also there is no punishment to the company. Failure due to any law means, suppose member became insolvent, court passed an order and court clearly told to the company, don't pay any amounts to that particular person. So as a result, company didn't pay dividends to that particular person. Now also company directors will not get any punishment. Next, most important Nidhi companies, if dividend amount is 100 rupees or less, so here just make an advertisement in local newspaper and display it on the notice board for at least 3 months. So now the members will come and they will collect their dividends. Okay na? So that is important point. For Nidhis, if the dividend payable is 100 or less, compliance with section 127 is sufficient if the declaration is announced in a local newspaper and displayed on the notice board for at least 3 months. If it is more than 100 rupees, directly post dividend warrants, directly deposit that amount to their bank accounts like that. So with this, dividends topic over. So small chapter. So we completed dividends. And next topic is accounts of companies. Chalo. Let's continue with the next topic, accounts of companies. As I told you, the weightage of this chapter is 5 to 11 marks. One descriptive question plus case scenario based questions possibility is there. So 5 to 11 marks is the weightage of this chapter. So in this chapter we are having a section 128 to section 138, 12 sections including 129A. Let's see one by one. First one, it's the duty of every company to prepare books of accounts including relevant records and financial statements for each financial year. So first of all, what comes under books of accounts, sir? Books of accounts includes 4 records. First one, receipts, payments, sales, purchases, assets, liabilities. These 3 are applicable to all companies, and 4th record is applicable only to the manufacturing companies. Cost items under section 148 applicable to specific classes of companies. So 4 records receipts, payments, sales, purchases, assets, liabilities, cost records. Next one, books and paper. See, books and paper is a broader term which includes books of accounts. Generally, books of accounts you will see financial records, whereas in books and paper you will see financial records plus non-financial records. For example, minutes, registers, documents. Okay na? So these 3 if you see, they are non-financial records. So books and paper includes financial records and non-financial records. Next one, definition of financial statements. As per section 2 clause 40, financial statements includes 5 components: balance sheet, profit and loss account. For section 8 companies we won't call it as profit and loss account, we call it as income and expenditure account. And third one is cash flow statement. Of course, 4 companies: one person company, small company, dormant company, and startup private companies. For them, cash flow statement is not applicable. And statement of changes in equity. And last one, notes to accounts, explanatory notes. So simply, financial statement includes 5 components: balance sheet, profit and loss account, cash flow statement, next statement showing changes in equity, and explanatory notes. Definition of the financial year. Financial year starts from 1st April, ends with 31st March. But this is an exceptional point. If a company was incorporated on or after 1st January, then first financial year closure date will be 31st March of following year. That means if a company was incorporated on 1st January 2026, then financial year period is 31st March. First financial year end date will be 31st March 2027. That means the next year. So if you see, the first financial year would be maximum 15 months. Suppose if it is 31st December 2025, sir, then financial year closure date will be 31st March 2026 only. So the shortest financial year date will be shortest financial year period will be 3 months 1 day. Maximum first financial year duration would be 15 months. So this is an exceptional point. Next, different financial year for global companies. If my company is having subsidiaries outside India, or I am subsidiary to a company incorporated outside India for the purpose of consolidated financial statements, and if they are following different period as financial year, now I can ask central government, please permit me to follow different period as financial year so that it is convenient to me for preparation of consolidated financial statements. So subject to CG approval, we can follow different period as financial year, need not be April to March. Next, IFSC companies, even without CG, even without tribunal approval, directly they can follow different period as financial year. So that's all about definitions in accounts of companies topic. Chalo, first section 128, books of accounts. Books of accounts requirement. Every company must maintain books of accounts that can express true and fair view of company affairs, including branches, and explain transactions at the both registered office and branch offices. So to exhibit true and fair view, books of accounts must be prepared based on accrual basis, and double entry system of accounting. So these two principles every company should follow. Cash basis not allowed, only accrual basis. Single entry system also not allowed, double entry system of accounting. Accrual basis records income and expenses as they accrue. Double entry involves recording each transaction with equal debit and credit aspects. Then where to keep these books, sir? Of course, registered office. No, sir, at some other place. For example, branch books of accounts I want to maintain at branch location only. Or company books of accounts I want to maintain at corporate office, sir, not at registered office. Then for that, condition number 1, obtain board resolution. Condition number 2, communicate the same with ROC in form number AOC 5, and such communication should happen within 7 days. 7 days of board resolution. So board resolution, and within 7 days of board resolution, communicate the same with ROC. Sir, can a company maintain books of accounts in electronic form? Yes, but books must remain accessible in India. They must remain accessible in India. Audit trail and edit log should be enabled. It cannot be disabled. Audit trail, edit log. Next one, books must remain in original or accurate form. In original form. Coming to the electronic maintenance of books of accounts only. So they must be in original form. And branch information should remain unaltered. No one should edit branch data. Coming to the storage, backup, daily one backup is required. And those backups should be kept in India only. Next one, service provider intimation. Suppose we are providing third-party software for maintaining books of accounts in electronic form. So you must provide details of the service provider. Next, branch office complaints. Proper books to be maintained at the branch. Summarized returns to be sent to the register office, quarterly. This quarterly is applicable to books of accounts. Yeah, just wait, ma. Proper books to be maintained at the branch and summarized returns to be sent to the register office quarterly. Next one, this is for foreign branches. foreign branches. Next, inspection by the directors. So books in India, any director can inspect during business hours, whereas books outside India, director must submit a written request and company must provide this information within 15 days of written request. Okay. So for Indian branches, they should submit the data to the head office periodically, maybe weekly once, daily once, monthly once, like that. But foreign branches, they should send the returns, they should send summarized returns to the registered office quarterly once. Coming to the inspections, ultimate responsibility of books of accounts maintenance is directors. So whether whether double entry system followed or not, accrual basis followed or not, whether books of accounts up to date or not. So directors can inspect. So any director can inspect for the books in India, books outside India. Upon 15 days of written request, yes, the books must be made available for inspection. Even inspection of subsidiaries is also available, but that require board resolution, for the purpose of consolidated financial statements. Directors can inspect subsidiary company financial statements, but for that board resolution is required. So board authorized director can inspect subsidiary books of accounts. Preservation period. Sir, how long books should be preserved, sir? Books should be preserved at least 8 years. For companies less than 8 years, preserve records for the entire period. Company is just 5 years old. Maintain all 5 years books of accounts. And CG can direct longer preservation during investigation. So during investigation, CG told company, for you it's not 8 years, you have to maintain records for 12 years. In such cases, the companies are required, the company is required to maintain books of accounts for 12 years. Next one, penalty for non-compliance. Section 128 non-compliance, fine 50,000 to 5 lakhs for managing director, whole team director finance, CFO and any other person made responsible for maintenance of books of accounts as designated by the board. So this is all about section 128. In section 128, accrual basis, double entry system of accounting and maintenance of books of accounts in electronic form. Only these three concepts are there. Next, 129, financial statements. Section 129. Financial statements must give a true and fair view of company affairs. For that, you have to follow Form Schedule 3, accounting standards, and automatically financial statements will exhibit true and fair view. Okay na? So coming to the presentation, Form Schedule 3, preparation of financial statements, comply with accounting standards. Next one, exemptions. Central government, this format Schedule 3 and compliance with accounting standards. These two are not applicable to insurance companies, banking companies, companies generating or supplying electricity. Simply, I call it as FAT. FAT means Form Schedule 3, accounting standards, true and fair view. FAT is not applicable to big companies. Big means what? B stands for banking, I insurance, G generation or supplying electricity. So FAT rules are not applicable to big companies or any other company specified by the Act. Non-disclosure of matters exempted under governing acts, example Insurance Act, Banking Act, does not imply non-compliance. Even though if you don't comply with Schedule 3 and if you are following respective schedules prescribed in respective acts, then it is not considered as non-compliance. You are complying the rules and regulations. That's it. Next one, financial statements must be laid before AGM by the board of directors for the financial year. And the rules which we discussed so far with respect to company financial statements, same are applicable to consolidated financial statements. In this consolidated financial statements, exemptions is very, very important. A company is exempted from preparation and presentation of consolidated financial statements if the following three conditions are satisfied. First condition, the company should be either wholly or partly owned by another company. Suppose, for example, our company is C Limited, it is having a subsidiary S Limited. And C Limited is subsidiary to H Limited. So now C Limited is exempted. Actually C Limited being a holding company of S Limited, it is required to prepare consolidated financial statements. In one case there is an exemption. That exemption is C Limited is subsidiary to another company. Okay now, C Limited is subsidiary to another company and C Limited members, other members Simply in C Limited, 75% of capital was held by H Limited. Balance 25% held by other members, others. Now these others should give NOC. Okay, company, even though if you don't prepare CFS, we have no objection. And condition number 2, C Limited should be an unlisted company. And condition number 3, H Limited should prepare consolidated financial statements which includes the figures of H Limited, C Limited and S Limited. Ultimate holding company should prepare consolidated financial statements. So these 3 conditions, if these 3 conditions are satisfied, then C Limited is exempted from preparation and presentation of consolidated financial statements. So with respect to audit, with respect to preparation of financial statements, with respect to audit, so for company standalone financial statements, what are all the rules we are following? Same rules are applicable to consolidated financial statements. If a company is deviating from the accounting standards, such a deviation must be disclosed. Also disclose the reasons, disclose the financial effects. So simply 3 disclosures, which standard we deviated, justification, and impact on the company profits, impact on the company net worth. Central government can exempt classes of companies from compliance in public interest either unconditionally or with conditions. Suppose IFSC companies exempted from section 129, like that CG is having power to notify few companies which are not required to follow 128, 129, like that. For defense companies, section 129, segment reporting standard is not applicable. So section 129 does not apply to government companies in defense production for segment reporting accounting standards. Of course, that company should be regular in filing financial statements under section 137, annual returns under section 92. Next one, non-compliance of section 129, the punishment will be imprisonment up to 1 year or fine 50,000 to 5 lakhs or both. Applicable to company's managing director, company's whole-time director finance, company's CFO. If these people are not there, then any person designated by the board. If that person is also not there, then all the directors will get punishment under section 129. 129A is all about periodical financial results. Companies here 2 types. Listed company, of course, they will publish quarterly financial results. So Companies Act is not talking about listed company. Companies Act is talking about unlisted company. So in future, CG may prescribe few unlisted companies to comply with section 129A. What is the requirements of 129A? Let's see. These unlisted companies should prepare periodical financial results in prescribed form. That periodical financial results may be quarterly or half yearly, like that. Obtain a board approval and complete either audit or limited review. Now file a copy of periodical financial results with ROC within 30 days of the relevant period. Like GST, you can see, right, monthly returns are there. For small taxpayers, quarterly returns option is there. Annual return is also there. Like that, here also, every year generally company prepare financial statements and the same shall be filed with ROC. But specific class of unlisted companies, for them maybe quarterly financial results or half-yearly financial results, like that they may specify and they will make it applicable to those companies. Now it is the duty of company to prepare the periodical financial results, get board approval, get them audited or at least subject to limited review, then file a copy with ROC within 30 days. Next one. Objective is to improve corporate governance in unlisted companies, particularly large ones with a widespread interest. Next, section 130, reopening of books of accounts on court or tribunal's orders. Reopening of books of accounts and recasting of financial statements. Conditions: if there is any application made by authorized entities, who are the authorized entities? Either CG or income tax authorities, SEBI, other statutory regulatory bodies or authorities, any concerned person. Other statutory regulatory bodies means, say for example, CBI, Enforcement Directorate, so ED, so or any authority. So these people can file an application with a court or tribunal. So court or tribunal had powers to pass an order for reopening the books of accounts only on the following 2 grounds. Only on the following 2 grounds. First one, fraudulent preparation of earlier accounts or mismanagement casting a doubt on reliability of the financial statements. So based on these two grounds, so court or tribunal may order for reopening of books of accounts. Next, court or tribunal must give a notice to central government, income tax authorities, SEBI, other statutory regulatory bodies, concerned persons before passing the order. Next one, revised or recast accounts will be considered final under subsection 2. Reopening applies to 8 financial years immediately preceding the current financial year, and reopening is permitted to 8 financial years only. Of course, if central government previously ordered company to maintain books of accounts for 12 years, then reopening of books of accounts is possible up to 12 years, up to 12 financial years. In section 128 we have seen books of accounts should be preserved only for 8 years. If CG ordered company to maintain books for 12 years, then reopening is possible up to 12 years. So here in this entire section you have to remember, just a minute section 130, yeah. So section 130, section 131 got clubbed. Section 130, 131 got clubbed. Just wait. So we'll do one thing. For this particular 130, 131, let's go with master notes. So small error, which will be rectified. Don't worry, it will be rectified by day end. Small error. Section 130, 131 got clubbed. So that particular 130 and 131 we will see in my master notes. Yeah. So just look at the screen. So reopening of accounts on court order or tribunal's order. So any of these 5 persons can file an application with court or NCLT for reopening of books of accounts. That reopening is permitted up to how many years? Just now I told you, reopening is permitted up to 8 financial years. And here such application will be filed only if there is a doubt. The doubt is earlier accounts were presented fraudulently or company affairs were mismanaged, leading to unreliable financial statements. So then court or tribunal shall give a notice to the applicant and consider their representations before passing any order. So the accounts are revised and recast shall be the final. No order can be made for reopening of the books of accounts for a period earlier than 8 financial years immediately preceding the current financial year. If the CG orders books to be retained longer than 8 years, accounts can be reopened for that extended period. So 130, that's it. 131, voluntary revision of financial statements. So what is 130? Reopening only when there is a doubt. Only when there is a doubt that company affairs were mismanaged or earlier accounts were presented fraudulently. And here who will be the applicants? Either CG or IT authority, SEBI, statutory body, concerned person. But coming to section 131, here it's a voluntary revision of financial statements. Here the applicant is company. Here the applicant is company. And section 131, the basis for section 131 is, sir, earlier we prepared financial statements not in accordance with section 129. Or earlier we prepared board report not in accordance with 134. So we identified the mistakes. We observed the mistakes. We identified the mistakes. Now we want to correct the mistakes. So self-correction, simply. Self-correction. So here the application can be filed by company and that application will be filed with NCLT only. Whereas section 130, application can be filed by government departments. And application can be filed with tribunal or court. So here only company will file application, that too with NCLT. Revision can occur with prior approval of tribunal through an application by the company. File an application in form NCLT 1 within 14 days of board resolution. So once board resolution has been passed for rectification of errors, now within 14 days communicate the same with NCLT. NCLT will immediately pass that information to CG, SEBI, tax authorities or any other relevant party. The tribunal will consider any representations made by these parties before issuing an order. Once only one revision is allowed. For example, 2024-25 related, you want to revise financial statements in the current year. Can I revise it? Yes, you can revise it, but that revision is limited to once. That means what? Sir, after 1 month, again I want to revise 24-25 financial statements. Sir, possible or not possible? Not possible. Only revision is allowed once. A revised statement or report can be filed only once in a financial year. Once revised, it cannot be revised again for the same period. And next one, detailed revisions for revision must be disclosed in the board report of the relevant financial year in which such revision is being made. Suppose in the financial year 26-27, we are revising 24-25 financial statements. So coming to 26-27 financial statements, financial year statements, board report, make a disclosure of the changes you made to previous financial years financial statements or board report. And revisions are limited to the corrections subject to 129, 134 necessary consequential alterations. And if you observe carefully, here revisions are limited to 3 preceding financial years. Only 3 preceding financial years. Up to 3 preceding financial years, you can go and you can revise. So this is one more difference between 130 and 131. CG had power to create rules to guide the revision process, such as replacing, supplementing the documents, defining the role of auditors, prescribing steps for directors. And coming to rule 77, application must include which financial year you want to change the which financial year related financial statements you want to revise. Contact details of the directors, CFO and CS, auditor name and details, board resolution copy, grounds for revision, and disclosure if auditors or any directors changed before filing such application. Advertisement of application is required 14 days before hearing date. So public notice simply. Next one, the tribunal shall issue a notice. The tribunal shall issue a notice to the auditor and heard him before passing an order. After approval, a general meeting may be called and reasons for the revision must be published in English and vernacular languages. At a general meeting, definitely it is an EGM only. At EGM, the revised financial statement, revised board report and auditor statement will be considered. Approved revisions shall be filed with ROC within 30 days of general meeting approval. It's like, section 137 filing of financial statements. So before I proceed further, very important to understand differences between 130 and 131. 130, it's a compulsory. 131, it's a voluntary revision of financial statements. So here the applicant can be central government, income tax authority, any regulatory authority, and here the applicant is just company. And here you can file application with either court or NCLT, whereas here application can be filed only with NCLT. Next one, grounds. Grounds for section 130. Grounds, basis for section 130. Earlier accounts were presented fraudulently, fraud in earlier accounts, or mismanaged. Whereas here the grounds are section 129 corrections, section 134 corrections. Here reopening you can go up to 8 years, whereas here revision you can go up to 3 years. 3 years. So these are the key differences between section 130 and 131. So 131 is like a self correction, whereas 130 is like a not self correction but government verification, a statutory authority verification. So that's all about section 130 and 131. So section 131 is missing. I'll add it, don't worry. Next, section 132, all about NFRA, National Financial Reporting Authority. So constitution, coming to the constitution, central government constitutes NFRA. The effective date is 1st October 2018, headquarters New Delhi. Applicability of NFRA, very important. To all listed companies, by default NFRA is applicable. Unlisted public companies, either paid up share capital 500 crores or more, turnover 1000 crores or more, loans, debentures, deposits 500 crores or more, then these companies are governed by NFRA. Special entities, namely banking, insurance, generation of electricity. So big companies are also covered. And any entity referred by central government considering public interest. The company is not falling in the above three categories, but central government is thinking that this company should also be governed by NFRA from public interest point of view, then that entity will also be governed by NFRA. And foreign subsidiaries, associates, if the income or net worth from that particular subsidiary or associate company exceeds 20% of the parent company, 20% of the parent company is coming from that entity. So 20% of gross, simply, consolidated basis. So 20% from any branch, not branch, 20% from any subsidiary or associate. Simply material subsidiaries, material associate companies, they are also governed by NFRA. Once a company or a body corporate other than a company governed under NFRA rules shall continue to be governed by NFRA for a period of 3 years, even after it ceases to be listed, even if it ceases to be paid up share capital criteria, turnover criteria, aggregate of loans, debentures, deposits fall below the limits stated therein. That means once you are coming out of the scope of NFRA, but still next 3 years you will be governed by NFRA only. So it's very simple, you are not falling in these 5 categories. Initially you were covered, but now you are not falling within these 5 categories. But still next 3 years you will be controlled by NFRA simply. Controlled means audit, everything. Review, audit. Next one, functions and duties of NFRA. NFRA protect public and investor interest by enforcing accounting and auditing standards. Specific rules includes maintaining the details of the auditors of above entities, recommending standards for CG approval, it recommend accounting standards on auditing to the CG for CG approval, enforcing compliance with the standards, monitoring also, publishing findings and taking action against non-compliance, promoting awareness of standards, collaborating with international organizations, suggesting improvements in the quality of auditing. Next, coming to the composition of NFRA, the head is a chairperson and others up to 15 members. Includes representatives from Ministry of Corporate Affairs, C&AG, RBI, SEBI, ICA and various other experts, and appointed by central government subject to the conditions. And all these members should be independent. So financially they should not be influenced. So they should be independent persons. Coming to the scope of NFRA, so professional other misconducted by chartered accountants or firms. It can take action either on suo motu or any application by central government. Next one, no other body can initiate proceedings once NFRA starts an investigation. Exclusive jurisdiction. So simultaneously, CBI or IT department, NFRA, so all the three will do investigation or no. Once NFRA take up particular case, NFRA will do it, NFRA will complete it. Next one, NFRA will have quasi-judicial powers. It can summon individuals, inspect documents or books, enforce compliance, penalize for misconduct. Individual auditors 1 lakh to 5 times of fees received, firms 5 lakhs to 10 times of the audit remuneration they received, and it may debar auditors for minimum tenure of 6 months, maximum tenure of 10 years. Next one, NFRA submits its yearly activities to the central government. Meetings will be held as per the rules. Next one, NFRA is also required to maintain books of accounts. Same shall be audited by C&AG. Results are forwarded to Parliament annually. Same like IEPF authority. Non-compliance, companies must inform NFRA of the details of auditors within 30 days of applicability of rules. And again, I'm repeating the point, entities remain under NFRA scope for 3 years even after they fall below governance criteria. Clear? So that's all about NFRA. Just in one page, this concept was summarized. Next, 134, that is board report. 134 board report. Next, approval of financial statements. Financial statements must be approved by the board before submission to the auditor for audit. And financial statements shall be signed by, board approval, board resolution is separate. Now coming to the signing, who signs financial statements are? Chairperson of the company if authorized. If chairperson is not authorized, then two directors shall sign financial statements. One should be managing director. And if company is having CEO, CFO, CS, then these people should also sign financial statements. Coming to OPC, one director shall sign financial statements. So simply chairman if authorized, or two directors, among them one should be MD, plus CEO, CFO, CS if appointed. That's it. For OPC, one director signing enough. And next one, similar rules applicable to consolidated financial statements also. Audit report shall be attached to every financial statements, every company's financial statements, every year financial statements. And signed copies of financial statements must be circulated, published with notes to accounts, audit report and board report. So standalone financial statements, you cannot circulate them without audit report, without board report. So all these are attachments to the financial statements. Coming to the contents of board report, web address for annual return, section 92, number of board meetings, director responsibility statement, fraud details, section 143, subsection 12. Here frauds are of two types. Fraud involving 1 crore or more, less than 1 crore. Less than 1 crore, report to board of directors or audit committee, and this will be disclosed in board report. Only these frauds only will be disclosed in board report. If it is greater than or equal to 1 crore, auditor shall report to Ministry of Corporate Affairs. Policy on directors appointment remuneration. Any qualifications by the auditor, comments for those qualifications, state of affairs, balance sheet, loans, guarantees, investments, related party transactions, steps taken for conserving energy, technology absorption, foreign exchange, outgoing, risk management policy, CSR activities, evaluation of board committees' performance. Formal self-evaluation. This is applicable only to these companies, listed companies or public companies with paid up share capital 25 CR or more. Next one. Next one. Abridged board report for OPC and small companies. So web address for annual return, number of board meetings, fraud details, state of affairs, financial summary, material changes, significant changes that happen, that happen between financial year closure date and financial statements preparation date. When financial year is getting over, when board report is getting prepared. So the time gap between these two dates. So during this time gap, any material changes shall also be recorded in the board report. Appointment of the directors, resignation by the directors, related party transactions, significant orders impacting company status, and explanation for auditor remarks. So important point, director responsibility statement, 6 points will be there. So directors are responsible for complying with accounting standards and accounting policies. They should apply consistently. Last year FIFO, current year LIFO, next year weighted average, like that, not possible. So consistent accounting policies. And company should maintain adequate accounting records. That is also responsibility of director. Preparation of financial statements in accordance with going concern basis. When we prepare financial statements in accordance with going concern, we follow historical cost method. If going concern is not possible, then we follow realizable value basis. Next one, adequate internal financial controls. This is applicable only for listed companies, and we have adopted systems to ensure compliance with all applicable laws and regulations. So 6 important points of director responsibility statement. Next one, signing of board report. It should be signed by chairperson. If chairperson is not authorized, then 2 directors should sign board report. Out of 2 directors, one should be managing director. Whereas for OPC, 1 director signing board report is enough. So here you won't find CEO, CFO, CS. So these people will not be there. Only for financial statements you can see CEO, CFO, CS. For board report only directors will sign ma. Penalty for contravention, company 3 lakhs, officer in default 50,000 rupees. Non-compliance of section 134, this is the punishment. Next, section 135, CSR provisions. First, what are not CSR activities? Which activities are not considered as CSR activities? Ordinary course of business activities, not a CSR. Political contribution, not a CSR. Employee benefits, not CSR. Marketing sponsorship, not CSR. Statutory obligations, not a CSR. Activities outside India, training activities outside India, not a CSR. Not a CSR. But activities outside India, if you are training Indian sportsmen for participating in Olympics outside India, that is eligible CSR expenditure. So that exception is there. Important point ma. In CSR, what is not CSR, what is not or what is unqualified CSR expenditure is very important. So political party donations, advertisements, marketing sponsorships, expenditures made in order to satisfy statutory obligations. All these are ineligible CSR expenditures. But remember that exception. If you are training any sports personnel outside India for Olympics or Commonwealth Games, that is eligible CSR expenditure. Next one, administrative overheads shall not exclude 5% of CSR expenditure. That you remember. Next one, if you see a CSR applicability, companies satisfying any one of the criteria in the preceding financial year, CSR is applicable. What is the criteria? Net worth 500 crores or more, turnover 1000 crores or more, net profit 5 crores or more. Any one criteria fulfilled, then to that company CSR is applicable. Under CSR, under section 135, so how much amount I should spend on CSR? How much amount I need to spend on CSR? So CSR expenditure, you can see at least 2% of preceding 3 financial years average net profits. Preceding 3 financial year average net profits, suppose 10 crores, 20 crores, 30 crores, 3 years profits. So average of these 3 is 20. Not 20 to be spent under CSR, 20 crores into 2%. 20 crores into 2%, we need to spend on, so 0.4 crore. So that amount you need to spend on CSR activities, CSR expenditure, minimum 2%. Next one. So for calculation of net profits, under this section, net profits excludes 2 amounts. One is overseas branch profit. If you are having branch outside India, from that branch you are getting a profit. Initially it is included in your financial statements. Initially it was the part of company profits. Exclude it because you are not getting that profit from Indian society, external, so exclude it. Next one, if you are receiving any dividend from the company which is already covered under section 135, to avoid double implication, so that dividend amount shall also be excluded. Suppose my company is receiving dividends from 2 companies. One is already covered under section 135, one is not covered. So a company which is not covered, that profit will be considered for CSR. Whereas company already covered, it already paid CSR amounts. That means it already incurred CSR expenditure. Again, if you are taking the dividends, on the dividends also, if you are calculating CSR expenditure, means double implication. That's why. So to avoid cascading effect, they clearly told dividend from companies which is already complying with section 135, exclude these amounts. Next one, ongoing project means it's a project. For completion of this project, minimum more than 1 year is required. So normal projects means within 1 year completion will be, project will be completed. Ongoing project means it's more than 1 year, but it should not exceed 3 years. 3 years excluding the commencement year. Suppose one project I started in the year 2026. 2026 is not considered. So 2027, 2028, 2029. By 2029 I should complete this project. By 2029 I should complete this project. Next one. CSR committee composition, general requirement, 3 directors should be there in CSR committee, including 1 independent director, 3 including independent director. If there is no independent director, then minimum 2 directors should be there in that CSR committee. For a private company, 2 directors shall take part of CSR committee. Foreign company, it's not about directors, persons, 2 persons, including 1 authorized person and 1 nominated by the company. One is authorized representative, other one is nominated by the company. So next one, this CSR committee is not applicable where if your total CSR expenditure is up to 50 lakhs. If CSR commitment is 50 lakhs, then no need to have CSR separate committee. Board of directors will take care of CSR duties, CSR functions, CSR committee duties, CSR committee functions. So duties of CSR committee, very simple. FRM. F, formulate CSR policies. R, recommend CSR policies and CSR expenditure. M, monitor. So that's what include project list, execution methods, fund usage, monitoring mechanisms and impact assessment. Next one, CSR reporting and impact assessment. So impact assessment is not applicable to all companies. My impact assessment applicability, just look at this point. Required for companies with average CSR obligation of 10 crores or more in the last 3 financial years. Applicable for the projects with an outlay of 1 crore or more completed 1 year earlier. So impact assessment will be carried for those companies where CSR obligation is 10 crores or more. And impact assessment is not applicable to all the projects of that company. Only one project where 1 crore or more expenditure was incurred. That too 1 year time period should be completed. 1 year time period should be completed. So an independent agency will come forward to do impact assessment. For carrying impact assessment or for having impact assessment, so maximum fees we can pay to independent agencies 2% of CSR expenditure or rupees 50 lakhs, whichever is higher. So this independent agency will not do impact assessment at free of cost. They charge some fees. How much fees they can charge? 2% of CSR expenditure or 50 lakh rupees, whichever is higher. Next, penal provisions. But before that, if you see duties of the board and other CSR provisions. So based on CSR committee recommendations, board of directors will approve CSR policy, and it is the duty of the directors to disclose the same in board report and publish it on company website. Ensure that CSR activities are as per the policy they have undertaken. Next, CSR expenditure, just now I told you at least 2% of the average net profits from the preceding 3 financial years. Priority should be given to the local area and surrounding regions of the operation. For meeting administrative overheads cost, maximum 5% of total CSR expenditure. For newly incorporated companies, no need to wait for completion of 3 years. So how many years it was in existence, just average the net profits based on the number of years it completed since incorporation. On that apply 2%. Next one, if any surplus is arising out of CSR activities, because of doing some CSR activities, if any surplus is there, like our main objective is to provide education. For that, we are constructing the schools and very nominal fees we are charging. Nominal fees. After deducting all expenditure, any surplus is there. That surplus shall not form part of company profits. That amount shall be utilized only for CSR activities. So reinvest into the same project. Transfer to unspent CSR account to be used as per CSR policy and action plan. Transfer to a Schedule 7 fund within 6 months of financial year end. So here it is all about unspent CSR amounts, unspent CSR funds. Here you can see ongoing projects, non-ongoing projects, some simply single year projects or more than 1 year projects. For ongoing projects, the time limit is once financial year is over, unspent amount shall be transferred to unspent CSR account within 30 days of closure of financial year. Within 30 days of closure of that financial year, transfer amount to unspent CSR account and utilize them in the next 3 financial years. If not, if unused even after 3 financial years, then transfer to Schedule 7 fund within 30 days after completion of 3 financial years. That means by 30th April of after 3 financial years. Whereas if it is non-ongoing project, single year project, then transfer unspent CSR amount to Schedule 7 fund within 6 months after closure of financial year. That means by 30th September. Here it is about 30th September, here it is about 30th April. Here it is 30th September of next financial year, whereas here it is after 3 financial years. Okay, next one. So if any excess amount spent under CSR, so it is, so here you can carry forward the same to the next 3 financial years, and you can claim set off also. So you can claim set off for excess CSR spending. CSR capital assets, any capital asset that was generated under CSR activities, such assets shall be registered in the name of Section 8 company or registered public trust or any society with CSR registration. So beneficiaries of the project would be like self-help groups or any public authority. Capital assets created before 2021 must comply with these requirements within 180 days after commencement of these rules. Of course, if you want time extension, you can get it, but not beyond 90 days. That means total 180 plus 90, 270 days. CSR implementation, company can directly implement CSR or through a connected charitable entities, that is Section 8 companies or registered trusts or societies, government established entities, statutory bodies, independent charitable entities with at least 3 years of experience. So this is indirectly with the help of other associations. So these entities should file CSR 1 form to register themselves with central government. Only with registered entities only we can carry CSR activities. So that's all about CSR. In CSR, the important points are impact assessment. One is impact assessment. Second one, applicability, that 500 crores, 1000 crores, 5 crores net profit criteria. And the third one is unspent CSR amount, treatment to unspent CSR amount. So when that amount should be transferred to Schedule 7 fund. If it is for ongoing project, what is the time period? If it is not an ongoing project, what is the time period? So these are very, very important points coming to CSR. Next, section 136. Rights of members to the copies of audited financial statements. Simply circulation of financial statements among the members of company. So documents to be circulated. First one, financial statements including consolidated financial statements if applicable, auditor's report, board report and other attachments. In case company is having subsidiaries, separate financial statements of subsidiaries. If audited, audited financial statements, unaudited, unaudited financial statements. So these will be circulated among the members. Who will be the recipients of these records? Every member of the company, every trustee for debenture holders and all other entitled persons, namely auditors, directors of the company. Next one, timing. At least 21 days before meeting, and for Section 8 companies 14 days before meeting that circulation should be happen. Sir, can I circulate them with shorter period, sir? Yes, for that you have to take consent of majority of the members with 95% of the value. Majority of the members with 95% of the value, their consent should be taken, then only such shorter period circulation will be valid. So conditions, the conditions which you have read for shorter notice under section 101, shorter notice in case of EGM with the share capital, the same criteria is applicable. The same criteria is applicable. Next one, mode of circulation. Two modes are available, electronic mode, physical copies. Electronic mode, it is applicable for shareholders holding shares in demat form. Next one, others, physical copies. Listed companies, they must make these documents available for inspection at registered office 21 days before meeting. Alternatively, send a summary in form AOC3 or AOC3A unless shareholder requests full financial statements. If they request full financial statements, give them full set of financial statements, or else just give them summary. Next, what about foreign subsidiaries, sir? For foreign subsidiaries, check whether they were in English language or not. If not, translate them in English language and obtain a certified copies. If they are already audited, circulate audited financial statements. If not, if audit is not applicable, then circulate unaudited accounts. If unaudited, upload unaudited versions with an English translation if necessary. Now coming to Nidhi company, individual service of documents to each and every member is not required, ma. So here members are of two categories: small members, others. Small members means hold less than 1000 in face value or 1% of the paid up share capital. Less than, it's not less than or equal to, it's less than 1000 rupees or face value, less than 1000 rupees face value or 1% of the company share capital. Then complaints can be done by public notice in a local newspaper, intimation on the notice board, inspection allowed at the registered office. So for small members, individual service not required, just give a public notice, attach these financial statements in the notice board, and inspection is allowed. Whereas others, that means big members, for them individual service of financial statements is compulsory. Next one, inspection rights. Any member and trustee of debenture holders can inspect books of accounts. Wrong, ma. Books of accounts can be inspected by only director. Remember, only directors can inspect books of accounts. So here I am talking about financial statements. Inspection of financial statements can be done by the members as well as trustees of the debenture holders, where at company registered office when during business hours. Non-compliance of this section, company 25,000 penalty, officer in default 5,000 penalty. Okay, now next section 137, last but one section. Applicability, filing of financial statements with ROC. All companies including OPC and NBFC companies, copies of financial statements including CFS, audit report, board report and notes to accounts, everything shall be filed with ROC. What is the time limit? Within 30 days of AGM. For OPC, within 180 days of financial year closure date. If no AGM was held, then within 30 days of AGM due date, file them as provisional financial statements. ROC will consider them as provisional financial statements. Once general meeting was conducted, once financial statements were adopted, second time filing is required. So that time ROC will consider them as adopted financial statements. So forms to use: AOC4 for standalone, AOC4 CFS for consolidated financial statements, NBFC, AOC4 NBFC, AOC4 CFS NBFC. Next one, XBRL filing. If you see, it is mandatory for listed companies and its subsidiaries, and any company falling in this category also, yes, XBRL filing is applicable. Paid up share capital 5 crores or more, turnover 100 crores or more, or company which is required to prepare financial statements as per Ind AS. So for them XBRL is applicable. Once applicable, forever applicable. Even you come out of this criteria, once XBRL was applicable to you, forever till liquidation of the company applicable. Foreign subsidiaries, attach unaudited accounts with the declarations translated into English language if at all needed. Unadopted financial statements, file as provisional statements within 30 days of AGM. Mark them as provisional until adopted. Same I discussed with you right now. Next, penalties, non-compliance. So this is the punishment, ma. Next, last section, internal audit. Applicability of internal audit is very, very important. Listed companies, internal audit mandatory, by default mandatory. Next one, unlisted public companies. If you see, 4 criteria were given. One is paid up share capital 50 crores or more, turnover 200 crores or more. These two we will check as on 31st March of preceding financial year. Whereas outstanding loans, borrowings, outstanding deposits, we need to check these two limits at any point of time during the preceding financial year. Suppose 30th November 2026, outstanding loans crossed 100 crores, 101. The very next day, 1st December 2026, we have paid 3 crores. So balance came to 98.